investing and the long-term approach in value investing. Uh, Now we will, in this session, we will talk about Buffett's moat. So basically, these are broad guiding principles based on which we can decide whether to buy a company for the long term or not. And they are guiding principles. They will guide you through the basic tenets that you need to look at into a company before deciding whether you want to buy them for the long term or not. Because the decision to make is whether you want to buy a company for a longer period of time or not. So this presentation will largely deal with it. It will give you some numbers, specifically what to look at, where to look at, and how to look at. So that should act as a guiding fence, basically, based on which you can decide what companies you can buy for the long term. Yeah. So we all have, in some form or the other, heard about Buffett's moats. So they are basically, as I told you just now, the broader guiding principles. There are 4 or 5 ways in which these can be looked at. There is scale advantage that you can have. There are other 3 4 advantages that you can have. It can be a low cost producer advantage that you can have. So there are 4 or 5 advantages. There could be some patents that you have that could give you an advantage. There could be an advantage in terms of your networking, basically, which is similar to something like a Facebook having a network advantage. So they have a huge network that gives them some advantage. Your products can have some advantage, because your products can gain a lot of mileage from the fact that they are usable by the clients, or they deliver some utility to the end customer. So that can give you some kind of moat. So we'll discuss at length about these various factors going ahead. So basically, what it talks about is that capitalism is brutal. If you invest, you must know how to identify a moat. So unless and until you are very conversant with how to identify a long-term story, it becomes very difficult to identify stories. Talking about them in the hindsight is much easier, where after say 5 10 years have happened, and you can come out and tell that you should have bought this and this has grown 10 times and 15 times. But in real time, doing this is a real project, and it's pretty hard to actually get those numbers out. So here are 9 financial rules of thumb that Warren Buffett uses to tell if a company has won. Pause. Yeah, sorry. So we got disconnected because of some technical issues. So here are 9 financial rules of thumb that Warren Buffett uses to tell if a company has one. So uh, there is a quote at the bottom which says that if you sit down with an orangutan and carefully explained it to it one of your cherished ideas, you may leave behind a puzzled orangutan or primate, but you will exit thinking more clearly yourself. So that is my incentive out of doing these trainings. So once I try to explain these to you people, my concept also gets much more clearer. But that is the advantage of teaching someone or trying to explain someone what you are doing. So it clarifies your understanding of the subject even more. So the first thing we will talk about is gross margin. So gross margins are relevant for a business. They are to be found in the income statement. It is gross profit by revenue. If it is consistently above 40%, it is considered as a moat company. If it is less than 40% or is volatile in nature, then volatility is also to be considered under various aspects. Like in a time of COVID, in times of implementation of a major economic reform in a country like a GST or something, obviously margins can move haywire for a short period of time. So that needs to be taken into account. But otherwise, if it is more or less consistent in a normal economic scenario, then you can consider that anything that has more than 40% gross profit margin is a decent business. So basically, the logic is that a consistently high gross margin signals that the company isn't competing exclusively on price. So as we all understand that if a company is exclusively competing on price, that advantage will get eroded because someone or the other will come up with a technological improvement in the process, thereby reducing their costs further. So if you are fighting only on price, that is your products are lower priced and hence you want to achieve better profits or scale or keep growing at a particular rate, that doesn't sustain beyond a point because some innovation or some changes in the broader aspects of the industry can really erode that. So high gross margin provides ample gross profit to pay expenses and leaves money for the shareholders. So it is basically, if it's a high margin business, then obviously your probability of getting back into losses or something in the event of an unnatural event is also much lesser. So how it is calculated, it is revenue minus COGS, you get the gross profit. So that is the logic that a high margin business will get you, keep you above water even in times of uncertainty. So sales, general and administrative expenses. So these are basically non-factory expenses which you incur after the goods are produced. Like till gross profit are the expenses which are at the factory level. Now, once the good has been produced, you have to incur expenditures to push them out to the stores or to the end consumer. You have to incur advertisement to gain that customer base. So these are basically those expenditures. So it is basically selling general and administrative expenses by gross profit. If it is above 30%, it's good. And if it is under 30%, it's good. If it's very high at around 80%, it's not a very good business with a lot of moat. Uh, the logic being that a good company with a good product profile will not have to incur a lot of selling and administrative expense to push those products to the end consumers because your product has some kind of brand recall or is fulfilling some kind of utility. So that is why these companies usually are not expected to have very high SG&A expense. So it is to be found again in the income statement only. So it is gross profit less selling and administrative operating expenses by gross profit. So it should be less than 30% of your gross profit. So depreciation is to be again found on the income statement and the cash flow statement. The formula is depreciation by gross profit. So Moat basically consistently under 10%. So the lower depreciation is the logic that a company having low cost of putting up a plant will obviously deliver faster yields if the sales multiples go up very high. If it is volatile and high, it is usually a no moat company. So Buffett's logic is if depreciation is consistently less than 10% of gross profit, it's a sign that the company doesn't need a lot of capital expenditure assets to maintain its competitive advantage and has a moat. Like we look at a lot of FMCG companies, the ROCs are pretty high. The reason being that they require very little capital to expand. Most of it is outsourced. The brand image and value has been already been created. So now based on this, they can just go on increasing their sales even on outsourced capacities where they don't have to put up their own capacities. The distribution network is very strong. So that gives them some kind of advantage. So that is why their depreciation costs and fixed cost charges basically are much lesser in nature. So companies which are highly capital intensive will not usually focus here because they have a lot of capital expenditure cost that they have to incur every time they have to increase capacities. So then there is interest expense. Again, it is found on the income statement only. The formula is basically interest expense by operating income. And if it is less than 15%, it is good. Over 50%, it is considered as a non-moat company basically. So the logic for this interest expense being lower is again stemming from the fact that the company has low fixed costs, the company has higher margins, thereby getting more cash into the business. So the free cash flow for the company is much higher because the margins are higher and your fixed costs have been lower. So that is why your interest cost should be lesser. So what happens is the cash flow yield, cash flow generation is higher. So that is why these companies will usually end up borrowing less to finance their working capital or long-term needs also, because your fixed capital cost is also much lower. So great businesses have such wonderful economics that they don't need to rely on debt. While the number varies greatly from industry to industry, it's a great sign if a company consistently spends less than 15% of its operating income on interest. So if 15% or less than 15% of operating income is spent on interest, that is a sign that the company is generating very good cash flows, has more or less high margins, and most probably the capex requirements are also very tamed in this case. So it is basically operating income, interest divided by operating income. Income tax as an expense. So income tax is again to be found on the income statement only. The formula is income tax paid by pre-tax income. In this case they are talking, but it is usually just in India it is around 25%. So the and companies that do not pay consistent tax or are erratic in nature are usually to be avoided on the mode principle. The logic being that a company that consistently pays tax is better, because that's proof that the company is making money and then paying taxes on that. An erratic mode of tax payment usually does not bring in too much confidence. In our case, it would be somewhere around 25 to 27%. So wide mode businesses make so much money that they are consistently forced to pay their full share of taxes. Companies that consistently have negative or an erratic income tax bill aren't as likely to have a durable mode. So basically what it means is that if your income taxes are very volatile in nature, ideally what should happen, your the dependent number, your income taxes are obviously dependent on your earning capacity, so your earnings could also be very errant in nature, or the actual cash flows could be errant in nature. So that is why you are not very confident about a company where the taxes keep going up and down. So rather it's a good, if it's a good company, your taxes should be more consistent in nature. Yeah. So profit margins are basically net margins found on the income statement. So it is net income by revenue. Consistently above 20% is a good mode company. Below 10% negative and volatile is a non-mode company. So the logic remains same that that a company that has high EBITDA and PAT margins, uh, they will have a high moat, because ultimately they will have more money to have more money for the shareholders, and it's an indication that competition is fierce. But in spite of that competition, the company can sustain that confidence and pass on higher prices and command higher prices and get more out of the consumers. So that only happens when your product has a good recall and good mind share with the customer. The next is capex. So this is again income statement and cash flow statement combination. You can also find it on the balance sheet basically, if you can do a bit of calculation out of your gross block and fixed block. The capital expenditure by net income. This is what gives you this is the formula: capital expenditure by net income. A moat consistently under 20%. So if your capital expenditures are low, as was the case with depreciation, if your moats are also, if your capital expenditure is low, then it should be less than 25% of net income. That is, less amount of additional money is required to increase your capacities. And if it is above 75%, then it means that for every additional unit of profit or revenue that you have to generate, there is a lot more capex that you have to commit. So that is why this business, that business does not look as convincing as the other part of it. So again, the logic is that capital expenditure eats into profits. If you have to spend a lot of money to keep putting on capacities, it dents into your profits. So companies that don't have to spend big on capex have more money to reward shareholders. Capital expenditure from Garrett can greatly vary from year to year. Averaging the result over 10 years is best. So obviously, any company that is doing capex just now, the capex requirement will not again pile up, say, for the next 2 3 years once the capex is being done, and then after that maybe 2 3 years as the capacity utilization ramp up happens. So usually during that period there will be no fresh capex announcements, barring the regular repair and maintenance or generally regular capex that a company requires. So that is okay, but beyond that, the big capex that a company has to do to substantially change the total capacity of the company, and that does not happen at a regular interval, and it is not very high either. So in this case, the formula is basically uh, your total capex expenditure, new capex, that is addition to gross block, should not be more than 25% of your net income. So that's good. So total liabilities to adjusted shareholder equity. Uh, this is to be found in the balance sheet, both items basically. So it is total liabilities by shareholder equity. And if it is below zero point 0.8, it's good. If it's above 2, it's not. If it's over 2, it's a no moat company basically. So the company does not possess any moat. The logic being that most businesses finance themselves with profits, not debt. So in a company where your capex requirements are lower, even renewed capex, that is fresh capex requirements, are also much lower, and your profits are good enough to support your business. So gradually that cash flow will come into play, and you will have lower debts. And most of the fresh capex, like you hear about a lot of companies doing capex with internal accrual, so these are companies which can finance their capex without debt but through internal accruals only. So your balance sheet is not burdened with interest cost and everything. So the earlier part we talk about lower interest cost as a percentage of operating profits, so that is also helped. So you're obviously, when you're not borrowing more to put up fresh capex, your capex requirement is not higher. So what will happen is that your cash flow generation will be strong. So then we have return on shareholders equity. So this is again a balance sheet item only, part of it balance sheet, part of it the income statement. The net income is to be found in the income statement. The shareholders equity or net worth is from the balance sheet. If it is consistently above 15%, it's good. Below 10% negative or volatile, it's a no mode company. So consistently above 15% is good. So return on equity shows how efficiently management is reinvesting its profits. So maybe I put up the first capex and it's been very successful. But for the next round of capex, which I put, or the money that I invest into my business, that also has to show the similar numbers. If those numbers consistently come down, then obviously my ROCs and etc. will also gradually come down. So a number consistently over 15% indicates that a business has a moat. Under 10% negative or volatile indicates that the business is struggling with competition. So generally, when would that happen? It would only happen when your competition is taking over you, you are losing market share. So what happens? You have to be more aggressive with respect to your pricing, or your product is not competent enough, or basically does not have a USP vis-a-vis your competitors to score in terms of higher pricing power. So we all understand what shareholders equity is. So it is basically your net worth, or the shareholders capital, and net income is obviously PAT. So this gives you that number. So these are some of the broader parameters, but we also need to understand that these are just broader numbers and they don't work in every stage of the stage of a company. So here we are talking about 4-5 stages of a company. So the first is the initial level, when it is like a VC or PE kind of story, where you have a lot of price and hope, basically. So price to hope ratio. So recently, most of the IPOs have been into this region where hope was building up valuation. So you had a lot of companies where those valuations happened because you willfully wished, you thought that it will just go up and there will be a lot of earnings traction, top line traction, and that will turn into a lot of share market frenzy as well. But that did not happen. In some cases, it does happen. Then in the second is where the launches and everything happen. That is, you start seeing, like, so if you look at Bharti Airtel could be a classic example in the past, which you could consider for these phases. So in the initial phases, prior to say 2003-4, there was a time when people were skeptical about how the telecom play out and how the company would profit, because at that point it was a growing game. People were not really understanding that a landline to cell phone shift can happen at that speed at which it happened later. So that was a case where Bharti catapulted into a different level. So that is this basically the launch. After the launch, some skepticism is given way to optimism, and gradually it starts moving up. Then you have stage 3 where you have hyper growth. So then came the stage of Bharti, where the company continued to grow at 20-25% consistently. There was revenue, there was customer addition, there was ARPU improvement, everything was happening together. So even in this stage, most of these principles, so stage 1, 2, and 3, the launch stage, the pre-launch stage, the hyper growth stage, most of these stages, these indicators that you've just spoken about, if you try to apply them there, they will not work, but they will work in a mature business that will continue to grow. So what we are trying to find is, we are trying to find ideas that will be there for the next 5-10 years, and they will consistently grow while they have already achieved a decent space within their segment, within their sector. And from here on, for the next 5-10 years will be the stage of mature growth that the companies will see. And that is why price to earning ratio will work here very well. Then obviously a decline phase will also come, which is part of any company. Kodak is a classic example. So that decline will also come if you are not able to keep up with the thing. So at that point of time, valuations and everything will not work. So consistency is a key. The real test is for company, if a company generates good numbers over multiple years and various economic cycles. There are plenty of exceptions and nuances to these rules. Many of Buffett's largest holdings do not pass even every rule of thumb. So it is like any parameter. If you apply all the parameters to a particular theme, it doesn't really work. Some parameters, some exclusion has to be done, and that adjustment will come along with experience and understanding. And it is, as we all know, that investment is more art than science. You can't really do it as a science that you do a 2 plus 2 and every time it comes to 4. So you have to understand the variable part of it. Uh, and as we see, investing and accounting has a lot of nuances. So this is basically a clawback. So gross margin should be more than 40%. Selling and administrative expenses should be less than 30%. Depreciation should be less than 8%. Interest expense should be less than 15%. Income tax should be around 25-26%, and a consistent income tax outgo should be there. Profit margin should be greater than 20%. Capex should be less than 10% of your operating income, and the debt to adjusted equity should be less than zero point 0.8, and return on equity should be more than 15%. So basically what it does is that you're buying a high margin business, low leverage business, low fixed capital requirement business, and uh, decently adjusted, decent leverage levels. Because if the prior precedents or the prior points as mentioned above are met, then obviously the debt to equity or debt return on equity will be better, and debt to equity will be lower for these companies. So these are basically just guiding principles. It's not necessary that everywhere you apply these principles you find a perfect match into these numbers, that everything falls into this category and you have perfect examples out of this. So I think that's it. We can open the floor for questions. If you have some questions, you can let me know. Yeah, so COGS is basically cost of goods sold. So cost of goods sold, it largely means the gross profit of the company. That is all expenditure that the company has incurred at the factory level prior to the selling administrative. So as the goods move out of the factory gate, whatever costs are incurred till that point of time is basically COGS. COGS. Uh, yeah, an Indian company with Moat that you like. So recently, I've been doing some work on data communication. So when I look at the company, it is a one of the largest undersea data cable companies, and it has connectivity in 190 countries. It is the major enabler for most of the cloud companies. It is a major enabler for most of the platform companies. And as we see the major threat that globally people are talking about, as we see more cloud and more people want a stable secure connection through which they can move on to the cloud. So Tata is a very good enabler out of it, where they create a mesh or a firewall kind of connection through which most of the data is transferred from your company to the cloud and vice versa. So that gives a lot of confidence to people that yes, it is on a safe place, because net is an open space. People are always scared about data being lost or misplaced through that. So Tata is doing that, and Tata Communication has corrected also. So one of the major aspects that we look at is margin of safety. So Tata Communication gives me that advantage as well. So I think Tata Communication is one company where I feel that moat does exist, because most of the people would not be able to replicate the kind of infrastructure that they've already put in place. And being a large company with presence in say 190 companies, that gives advantage. And consider, in addition to that, consider the fact that we are going into a stage where 5G will get implemented, and a lot of that will translate into a lot of data, where machine to machine transaction and machine to machine communication will increase. uh, Later in the days you will have a lot of automated driving also coming in. So with 5G, solar power, a lot of grid connectivity is happening. So I was reading on their website, they did something for a company whereby the grid improvement happened at a very rapid scale. So these are the things that they are doing. I think it's a very decent space to be in. So Tata Communication is one company that I feel has that definite moat, which could aid the long-term growth. No, see, basically these are not like hard thought rules or hard fought rules. Basically, that you have to follow. Like any investment, this is also these are also probable broader fences, like within which you have to form your opinion. They are just guiding principles. Not necessarily every company will fulfill all these criterias, but yeah, most of the companies, some of the companies will fulfill maybe 60-70% of the criterias. Rest you have to take a judgmental call as to whether the other aspects of it are falling in place or not. Okay, so since we don't have any more questions, we will just conclude this.